In this presentation, we're going to make loan payments with the use of an amortization table, breaking out the interest and principal portions of the loan payments as we do so. Let's go with Xero. Here we are in our Get Great Guitars dashboard. We're going to be opening up our balance sheet and income statement this time by going to the accounting dropdown. We're going to open up our balance sheet. When that opens up, we will duplicate it by going on up to the tab up top, scrolling over to it, right-clicking on it, and duplicating that tab. Let's open up our income statement, going back to the tab to the left, hitting the accounting dropdown again, going down to that old income statement, our other financial statement report. We're going to then duplicate that tab, going to the tab up top, right-clicking on that tab, and we'll duplicate that tab as well. Let's then go back on over to the balance sheet, which is going to be the report on the right. Change the date by going to the date drop-down. We're going to be going to the month of January. Let's go to the end of the January here, because that's the month we're working on. We're going to be updating that. And there we have it. Now we're going to go down to our liabilities down here, and we have our loan payable. We're going to assume that we're making a payment on the loan. We're going to be recording that payment and breaking out the interest and principal portion. That's going to be kind of the confusing thing that we need to do. Most of the transactions we've had thus far have only had, two sides to them, two accounts affected. Now we have kind of three accounts that are going to be affected. Remember, when you do have a loan, you're going to have to, if you want to break out the interest and principal, you're going to need some type of amortization table. If it's a standard type of loan where you're making monthly payments and you should be breaking out the payments between interest and principal, you typically need an amortization table to tell you what that breakout should be, and it will differ every time you make a new payment on it. So for example, here, we're going to go to our amortization table. We're going to say, hey, I know what the loan payment is. It's this. But we need to break it out between principal and interest. So this is the loan that we're on right now. This is where we're at this time. And we're going to be breaking out this payment between interest of $300 and principal of this amount, which will leave us with a loan balance of $70,941. That's where we should be after the payment has been made. So let's go ahead and check that out. How would we do that then in our system? Or let's think about what will happen. The loan balance here is going to go down, but it's going to go down to the 70,941 about, because there's rounding. And then the other side of this is going to be decreasing cash for the full amount of the payment, checking account going down, and the income statement will then have an income account that will be increasing for the interest of 300, which will be decreasing the net income. So it's going to be decreasing the net income. And we're actually out into February now. We're on the second month. So on the balance sheet, I should go back to the balance sheet and I should be changing this to not to January, but to February. So I'm going to bring this out to February. And there we go, February 29th. So there we have it. Now I'm going to go back to the first tab and we're going to enter the transaction. Now cash is affected, so I can't go to the plus button and say this is going to be money going out. We're going to be spending money. Spending money. Form is the form that we will be using. We will be spending money out of our checking account, so we're going to be taking it out of the old checking account, so we'll pick that item. Here's our spending money form, so I'm going to scroll up a bit so we can see it more of it. I'm at the 125. I'm going to select the date. I'm going to say this is at the beginning of February, so I'm going to say February 1st is going to be our first transaction, and then we're going to say down here this is a loan payment, and I'll say first loan payment, maybe something like that. And then we're going to have to select the accounts that are affected. Now, we know that this form means that the checking account is going down. Money spent, checking account's going down. So we're going to put the other two accounts that will be affected, which will result in the money going down of the difference of $1,359. Other two accounts affected are that interest is going to be going up. So the interest expense, we can think about the interest expense as one account. So I'm going to say, all right, one account is going to be interest expense. It'll be for 300. And let's see if they have an interest expense account. So if I go down here, I'm looking for an expense account for interest and don't see one. So I could type one in there and double check interest. Don't see it. So then I'm going to add an interest expense. And maybe I want the interest expense down here on the bottom. So I might want it down here like in the 7150 or maybe like 8,100 even. I should have it on the bottom. So maybe the 8,100, I'm going to be adding an account and have a new account. And I'm going to put the 8100 as the account number. And then if we select the accounts, it's going to be an expense type of account. So that's what I'll pick up, the expense type of account, and the name is going to be interest expense, interest expense, and save that one. And so we have an error occurred. Please enter a unique code. So that code seems to be taken somewhere. Is that really? I'll say 10 and try that and save that one. All right. The other side, I'm going to put the same description here, is going to be 1, and I'm going to put 1 here, and the amount is going to be now a negative because this is going to be the loan payable increase in a liability. So that's going to seem a little funny. We're going to say it's the negative 1059. So I'm going to say it's a negative 1059, and this is going to go to the loan payable or note payable, which I believe we kept the first one. Let's just double check that. If I go back to the income statement, we're down here on the note payable, which is going to be we want the one with the 3458. 3458 note payable. So if I go back here, I picked up the wrong one. Now notice I'm not using this account. We might want to go and make this account basically inactive so I don't make that problem, make that error. Note payable. And we want the 3458. So there we have that. And notice I actually have this going the wrong way. I had a negative here, and that means the balance is not correct. So what we need to do is I'm going to remove the negative. These are going to be a positive, and that means the balance is going to be correct. So what's going to happen then when we record this, it's going to be money spent. That means the full amount, the 1359, is going to be decreased in the checking account, which ties out to the full amount, the 1359 over here. Then we're going to be increasing the interest expense by the 300, and we should be decreasing the loan by the 1059. Let's check it out. Let's go ahead and post this and see what happens. So I'll say save here. Then I'm going to go back to the balance sheet. So if we go back to the balance sheet and scroll back up, we're going to go into the checking account. Let's check out the old checking account. And then scroll down, and we have the amount of the 1359 going out there. That makes sense. That ties out to the payment amount. Then let's go back into it, and I'm going to go back up to the balance sheet. Let's check out the other side down here, which is going to be the note payable is now at the 70,941. Is that what it ties out to here? 70,941. That's what we would expect. Let's go into it and see the transaction on it. So we're going to go into the note payable. Scroll on back down, and there it went down by the 5059. So the 5059, and that is the decrease in the principal. Now we just need that $300 amount. So I'm going to go back then to the balance sheet, go back to the income statement then. Let's update the income statement. Updating the income statement. We should then see at the bottom of the income statement a interest expense. So it's at the top here. We have the interest expense of the 300 in the income statement, bringing the income down. Now, let's just to contrast this, let's imagine that it's the end of the month. I'm still going to put it in there in February, but let's say a month passes and now it's February 29th, the end of the month, and we have to enter the second payment just to contrast and see what happens and see kind of the problem with this type of payment. And when you use this method, when you use the amortization table, is that you can't memorize the transaction. I can't just say, hey, you know, just next time I have this come out, and if you're using bank feeds or something like this, this amount will come out automatically. You can't say, hey, just hit the other accounts like this and make it the same, because notice they're different now. So you have to go back in there and enter a different transaction for the second payment, even though the payment amount is the same. That's kind of the problem. Let's give an example of that. So if I go back over and post the second payment, imagining a month went by, but now we're going to enter it as of the end of February. So at the beginning of February, first payment. Now we're going to make this one at the end of February. So same item, going to say plus button up top. We're going to spend money. It's going to be coming out of the checking account. So we're going to say it comes out of the checking account. And then I'm going to say this is Chase. So I'm going to say this is Chase is our bank. So that's going to be that. The date is going to be the end of February. So I'm going to take this as of the end of February. February 29th is going to be the date. And then we're going to do the same method down here. This is going to be the second payment. And same method, but this time we're going to say the principal is going down, or let's say the interest is 296. So I'm going to say 296. Whoops, let's do that one more time. This is 296. And then the account then is going to be interest, just like we had before. And then this is the second payment. And then the principal reduction then is going to be different. It's the 1063. So I'm going to say principal deduction 1063. And this is going to go to the loan or note payable. I think this is the one we wanted it to be. Let's double check that. I'm checking the number of the loan. So here's, if I go back to the balance sheet, that's the value of having this kind of number at the end. So that looks good. And the balance is, the amount of payment is the 1,359. And that ties out to the 15359 here, but now we have a different breakout. What's going to happen when we record this? It's going to decrease the checking account by this. It's going to decrease the loan balance by this to this, hopefully, right? And then it's going to increase the net income, or the income statement, the interest income, which will decrease net income by the 296. Let's save that one and check it out. So I'm going to save that. We're going to go back on over to the balance sheet, and I'm going to update the balance sheet. So let's update the balance sheet. Then let's go into the cash, go into the checking account and see what happens there. Scrolling back down, we're going to go down and we see the second payment that happened. Same amount coming out of the checking account, right? Same amount on that side of things. Then let's go back over to the balance sheet and see the things that will change. We're then going to go down to the liability account, the note payable account. So let's scroll on down there. There's the note payable. It's now at the 69,878. If I go back over here, it should be at the 69,878. So that looks good. Then let's go into it and see the payments that have been made. They're a month apart, even though we put them in the same month here, just to put them side by side to see the difference in the transaction detailed report. You can see down here, then we have the money spent, same form, but the two amounts are going to be different now because of the difference between the payments. Same payment amount, different amount allocated to the principal. So then I'm going to go back up top and let's check it out on the income statement. Going into the income statement, if we update that report, it's going to update that report. We're recording the interest for the two payments in the same month because we recorded them a month apart, but we paid them both in the same month here. If we go into the interest, then we have the same amount of payment that came out of the checking account, but the amount of it allocated to the interest expense, then you can see will differ as well. So that's going to be part of the issues that you want to deal with regards to the loan payments. You're going to need an amortization table typically to break that information out. Or, again, you can do it periodically. You can just say, if you have bank feeds set up, you just say, hey, just hit the loan with every payment, and then rely on periodic adjustments at the end of the month or the end of the year by yourself or your accountant to break out in accordance with the amortization table at that time.